The Federal Reserve cuts interest rates. What does this mean for the stock market moving forward? And are we entering a very bullish time of year? I'm going to answer all of that in just a moment. Hey friends, Adam Hammer here, Chief Investment Officer at Hammer Financial Group in beautiful Lockport, New York, and Myrtle Beach, South Carolina. All right, so about a week ago, the Fed chairman came out and said the Federal Reserve has reduced interest rates by 50 basis points or 0.5%. Why does that matter? Well, to keep it really simple, interest rates come down. The cost of borrowing money, in theory, is cheaper. Borrowing costs are lower. If borrowing costs are lower, that means companies can, in theory, report higher earnings because their borrowing costs are lower. And if they have higher earnings, that means potentially higher stock prices. So that's at least one possibility that lowering interest rates could lead to a surge in stock prices. There's a lot of history about that we won't get into because there's been other periods where that hasn't happened, but that is at least one possibility that lowering interest rates could be a big benefit to the stock market. The other interesting thing about this is that if you take a look at the month of September, September is historically a very bearish month. But if you take a look here from Google Finance, this is a 1-month return, basically starting right at the end of August, early September. You can see that we're up over 2% in the S&P 500. Again, that's something that historically, very, very tough time of year in the late summer months, particularly September, but we're bucking the trend a little bit, which is interesting. I think the interest rate cuts certainly have a big part of that as to why September has been, at least so far, a positive month. And what I want to show you next is perhaps what's most interesting about this video that I'm sharing with you today is take a look here. This is a graph that shows the returns of the S&P 500 and the NASDAQ by calendar quarter. So if you take a look at this graph, just go all the way from left to right, take a look. The fourth quarter, which we are entering soon, October, November, December, the average annualized return in this quarter, double-digit returns for both indexes, both in the first part of the quarter number 4 and the second part of quarter number 4. So historically, going back many decades, we're entering a very, very bullish period. Now, there is one note of caution here. I know many of you are aware that we do have a presidential election coming up in November. So it's at least possible that we will see some volatility before the election. Historically, that has been the case prior to the election. Things can get a bit dicey. But typically after the election, whoever wins, we typically see a rally in the market. So we are entering very soon the most bullish time of year. We've had a pretty good year overall. As I mentioned, September has been better than expected. So we will continue to keep an eye on this and look out for a future video where I'll talk about how the election may or may not impact the stock market in a way that many people think. Before I sign off and send you on your merry way, I do want to just show you this real quickly, which is our website. This is paulhammerfinancial.com. We have a number of resources. All of our YouTube videos is right under this tab, which is our insights. But if you ever need to get a hold of us, easiest way is you just click this pink box, contact us. You click the contact us page, and then you'll just have this fill in here and enter your information, and Paul and I will be in touch with you very, very soon. So exciting times in the stock market, exciting times to be alive. And I want to thank you so much for watching this video. I will see you on the next video, which is coming up soon. Take care. Bye-bye.